All right, let's go. Let's get started. I hope everyone can hear me well. My name is Michael Atias, and I'm going to do a short presentation on behalf of OTA Tax Pros. Let me first introduce myself formally. My name is Michael Atias. I'm the Director of Tax Services at OTA Tax Pros, which is fueled by Online Trading Academy. For those who know us, we are a school that teaches people how to trade the stock markets, futures, forex, commodities, pretty much all assets that are out there. We've been around for many years. We have 40 offices around the world, including in London and in Hong Kong and in Indonesia and Dubai and, of course, in the United States. So primarily the presentation today is going to be for those who are filing tax in the United States. For those of you who are not, this could be just an educational purpose for you. So let's get started. Like I said, I'm the Director of Tax Services at OTA Tax Pros. A little bit about my background. I have an MBA from Washington University in St. Louis, focusing on accounting and finance. I also have a bachelor's in economics and business management, and I'm also an enrolled agent. Yes, I do know Sam. By the way, some people are asking questions. I know Sam Staten. Obviously, he works with us here for a few years now. By the way, an enrolled agent is a certification awarded by the IRS that allows me to represent taxpayers in all 50 states on all tax matters. So it comes in very handy if anyone ever gets examined or selected for examination by the IRS. This has some weight when we go through an examination process. A little bit about the type of services we provide. We provide, obviously, consultation, tax planning, tax preparation. This is a time of year where most of us are filing their taxes, entity formation assistance. Some people want to trade through a corporation. We're going to talk maybe a little bit about that towards the end of today's presentation. We provide that service. We tell you what type of entity is the right one for you, what structure of ownership should you take, what state should you form it in, all the questions people ask all the time. Should I put my spouse in there? Can I pay salary to my children? Things like that. We assist with you. Usually it goes through the consultation. We'll have a special offering today for those who are attending the FX Week webinar regarding that consultation. And we talk about also those who are trading their retirement plan accounts. We have some strategies for you as well. And, of course, any type of audit representation problems with the IRS. The purpose of today's presentation is very simple. We all know the concept of return on investment. But the problem is that we can trade with $100,000 and make $50,000, $60,000 a year, but the government will come and scoop about a third to a half of that. So that reduces our return on investment from 50% or 60% closer to something like 35 to 40%. So obviously, when we're doing this over time, we're losing a lot of money because the money goes to the IRS rather than staying in our trading accounts. The whole idea here today is how to increase your cash flow, how to find ways to bring, to keep more of the money, more of the profits that you've earned through trading in your trading account. And I have a few quotes for you on that. There's a gentleman who said back in 1950s, he said, proud to be paying taxes in the United States. The only thing is I could be just as proud for half the money. And the concept here is very simple. We know we teach, this is actually Sam's concept, we teach this concept of wholesale and retail. So when you're trading, it doesn't matter if it's a stock or if it's a futures contract or if it's a forex. It does not matter what the transaction you have. We teach the concept of wholesale and retail. So you should buy at wholesale and sell retail. It's very simple. That's what most businesses do. They buy wholesale, sell retail. Same thing here. If you're going to pay $5 in tax, $50,000 in tax, or $5 million in tax, you're going to get the same type of services from the government, and that's true for every country. You are not going to get preferential treatment. So what we propose is to obviously minimize this tax liability with the point of we're going to get the same type of services, but we, in the same token, we do not want to expose you to any unnecessary examination from the IRS. And the other thing is, they get a lot of people is that they feel that the government is their silent partner, and they're not silent, they're actually very vocal. And this following quote shows that. It says, you ever notice that when you put the word V and the IRS together, it spells theirs. So IRS stands for Internal Revenue Service for those who are not U.S. Persons. So it kind of shows the concept of how the government truly is your partner. So now let's get into the program. I'm going to ask you some questions that you should know. And we're going to go through them quickly as I'm going to talk about them more into the webinar today. First question for you. People ask all the time, can I write off my trading losses? And the answer to that is yes, but it depends on your filing status of how much can you write off. Okay, so we'll talk about that in just a few more minutes. Then is my education deductible? There's a lot of online trading academy students or people that have taken classes elsewhere. They spend thousands of dollars on this education. And the question is, can I write this off? Can I take this against my income from trading or against any type of other income I have? And the answer, again, it depends on your filing status. Okay, that depends. What is your filing status? For one, it is deductible. For the other, is not. We'll show that in a few minutes. Then, what's mark-to-market accounting? For those of you who are not familiar with that, we're going to cover that. What is the need to incorporate? Do I need to incorporate? Should it be an LLC? Should it be a corporation? My CPA should know about this, right? And the answer is that not necessarily, because most CPAs and accountants in the U.S. do not specialize in tax trading rules. Actually, there's very few firms that do. Maybe less than 10 fingers the amount of firms that specialize in this. The reason is very simple. Most people in this country do not really trade. They just give their money to a financial advisor who buys a bunch of mutual funds, and that's the end of it. So there's no need for them to know anything about active traders. But that's what we do at OTA Tax Laws. We specialize with active traders or people that want to be traders. We tell them about all the different rules and what has to happen, what to qualify for trader status. We'll go into that in a few minutes. What are wash-tail rules? We'll talk about that if you don't know what that is. And then my question to you is, what is your tax strategy? Okay? You have to have a strategy. Just like you have a strategy of trading, you have to have a strategy for taxes. If you do not, the IRS will select one for you. And you can be pretty positive that if the IRS will select one for you, it's not a favorable one for you. The government is going to choose the interest of themselves rather than the interest of the citizens. That's not surprising. So again, the question is, what is your tax strategy? You need to have one. So now let's start with the actual program. So a lot of people ask, what are my filing options? And the answer is very simple. There's only two filing statuses. First one is an investor, and the second one is trader in security status. To qualify as an investor, you have to do nothing. That's the strategy the IRS selects for you. Okay? So that is the strategy the IRS will select for you. We'll show you the benefits of being an investor and the disadvantages. The other status is a trader in security status, which is a coveted status that you have to earn this status, and we'll show you the immense benefits of being a trader in security status as we go through the webinar today. So now, what are the advantages of being an investor? The investor really has one advantage, and that is long-term capital gain rate. Currently, that is standing at 15%. At the end of this year, at the end of 2012, that rate is going to be canceled, and we're going to go back to what was back in 2000, which is a 20% rate. Unless Congress comes to some type of new tax reform, and it may be that this rate will change. But the likelihood of it being remaining at 15% is small. It is probably going to go up to at least 20%, maybe even higher, maybe canceled altogether. So we don't know quite yet what will happen. That depends a lot on the upcoming election. That's the only advantage the investor has. Now remember, you have to have a long-term position, which means a position that is longer than a year. Longer than a year. So most active traders do not have a lot of these positions. At least from what I see, most of our students and most traders are intraday traders, swing traders, maybe short-term position trading, but nothing like they held stocks for 3 or 4 years or any type of other type of contract for that length of time. So that advantage is not really an advantage for most traders There's more of an advantage to those who just buy, suppose, let's say, mutual funds or things of that nature. Now, what is the definition of an investor? So let's understand that first. An investor is a person that purchases and sells securities or other investments with the principal purpose of realizing investment income in the form of interest, dividends, and long-term capital gains. And usually report that on your Schedule D. So most people have had that before many times. That's what we call the buy and hold strategy. As we mentioned, that strategy is not very popular these days and not a very effective one either. So let's look at the disadvantages of being an investor. The first one is that your losses are limited to $3,000 a year. So you could be a successful trader and make money, but every now and then a person can have a year when they lose money. Or if you're a beginning trader, there's a likelihood, actually a high likelihood, that at the first few months of trading, you're going to encounter some losses. And those losses are limited to only $3,000 a year. That's it. So if you lost $50,000, you can only write off $3,000 in that year, and the remaining will push forward to future years. So it creates a problem where you don't get the full write-off in the year you had the losses. So rather than getting money back from the government, you're actually going to have to wait a number of years before you can utilize these losses. That's a clear disadvantage. The second disadvantage is that we have wash sale rules. So let me explain what wash sale rules are. Wash sale is basically when you buy a security and then you sell that security for a loss. The trade didn't go your way. You got stopped out. Does not matter really what the reason is. You have a loss on the book. Now you want to get back into that same position again. If you buy that same position within 30 days, that is considered a wash sale, meaning that transaction gets reported on your tax return. However, the loss gets washed out of your profit and loss calculation. Now, there's a few problems with this. First, you got to report all these wash sales. So if you're an active trader, you're going to have a buy, sell, buy, sell, buy, sell all the time. And throughout these buy, sells, you're going to have some small losses here every so many trades. And those losses are not going to be able to be deducted from your overall trading activity. That's one problem. The other problem is you got to report all of these, so that takes time and money if you're working with a professional accountant. So at least there's room here to get tax notices from the IRS, as this reporting activity is very tedious. And this year there's a new form that came out, Form 8949, that even makes the reporting on trades more complex than it was. Obviously, the government's not making it easy on traders anymore. So there's even another layer of complexity with this wash sale. Now, I'll give you a short example how this could affect your cash flow. Suppose that you're trading, you're up for the year, you're up, let's say, $50,000. But towards the end of the year, but in that $50,000, you have a bunch of wash sales. So there's a loss of about $10,000. So what will actually happen on your tax return is that you'll report income of not $50,000, but rather $60,000. You'll get that $10,000 back in the following year. However, you've just squeeze yourself out of a few $1,000s in this year, and you have to wait a full year to pass before you can get that money back. So that's not smart business. So that's part of the problem we have with wash sale rules. The other thing is, sometimes this can affect your style of trading. For example, when a trader has some open positions at the end of the year and they're losing positions. So a lot of accountants would recommend what we call tax loss selling. We are familiar with this term. Wall Street does this every year. Hedge fund managers do this every year to boost up their performance. They sell the losers. Okay? Sell the losers. And it's a valid strategy. However, you're forbidden from getting into the same position within 30 days. Because if you do that, that will create, again, the wash sale effect. So that affects your style of trading. We're going to show you later how the trader and security status does not have any of these limitations. Next, disallowance of certain expenses like attending seminars, education, going to trade expos, home office expense. Some people are trading from their homes and they can write up a portion of their rent or mortgage interest and a portion of their utility bills and so on and so forth. Those expenses are not deductible. That's just an example of what's not deductible. There's a long list of what's not deductible. So here the disadvantage is clear. You're losing thousands and thousands of dollars in deductions you could have had, but because you're classified as an investor, you don't have. Now remember, this is the strategy the IRS selects for you. Okay? Then we're talking about margin interest. Obviously, we all know what margin interest is. That's trading with brokers' funds. That costs us money. That margin interest is limited to our net income. So if we are up for the year $10,000, but we spend $20,000 in margin interest, we can only write off $10,000. What if we spend $12,000 in margin interest and we lost $1,000? We won't be able to write off any of our margin interest. So clearly, this is a clear disadvantage here. You're not getting expenses that you had that are directly related to your trading because you didn't make money. And lastly, those investment expenses are deductible, like platform fees, like your internet connection, like your phone. Those direct expenses, they're treated as what we call an itemized deduction, subject to the 2% adjusted gross income limitation. So, quick example, if a person makes $100,000, their AGI is $100,000. 2% of that is $2,000. So the first $2,000 worth of expenses are not deductible. So this is for most people a loss of about $600 to $700 right away every year. And then you have to still itemize your deductions. So not everyone itemizes their deduction. Excuse me. Not everyone itemizes deductions. Some people don't own homes. Some people don't earn high salaries, so they're not paying a lot of state income tax. So there's nothing to build their itemized deduction. So if you're not itemizing your deduction, it doesn't really matter. You can't take this deduction anyway. And if you are itemizing your deduction, the first 2% is lost. That's $100,000, the first $2,000. If you're making $200,000, it's $4,000, and so on and so forth. And then we're also running into issues of alternative minimum tax. Some of you may have experienced that in the past. So as you can see, there is a lot of limitation on the investor. Not a lot of advantages. One advantage is long-term capital gain rate. We've already established that that advantage is not applicable to most traders, but all of these limitations are applicable. And I get the question all the time, well, why is that all these limitations are in place? Well, I don't know. That's what Congress wrote. It's a political thing. But my thought behind it is that had the IRS had to give us all of these deductions, they would be losing a lot of money. In a sense, if we go back to the crash in 2008, and under certain researches that were done, just in retirement accounts alone, the market lost about $7 trillion. So if we add portfolio accounts to that, the number probably is over $10 trillion. That's a staggering amount. Suppose the government had to refund us just the average tax bracket, which is 25%. We're talking about $2.5 trillion. On a good year, the United States government collects about $2.4 trillion in taxes. So it's just not feasible for them to refund us all this money or to allow us all these expenses. So therefore, they put all these limitations in place to kind of like not give us the full write-off. And again, that's the strategy the IRS will select for you. Now, the question you should ask yourself at this point, am I a trader? Meaning, am I a trader in the eyes of the IRS? Not in my eyes, not in your eyes. Obviously, you are trading. You're taking the time to attend this webinar. But we're talking about is that the IRS qualifies as a trader. So let's look at what the IRS says about this, okay? And this may be a surprise to you, but there is actually no revenue code or a regulation that defines what a trader in securities is. That means that no law was ever written that defines clearly what a trader is. You have to make 100 trades a year or something like that. Nothing. So it creates issues. Why is that? Because remember, what the IRS says to you are always, you're an investor. So if you're selected for an examination, and the IRS will claim that you are an investor, and you will try to claim that you're a trader, we'll soon show you why you want to be a trader. But you'll claim that you're a trader. There's going to be an impasse. We're going to go to the law. The body of law doesn't say anything. So at that point, it's between you and the IRS examiner. What is your status? So because of that impasse, there's been dozens and dozens of people that went to court. So there's a lot of court cases. And from these court cases, we've analyzed them. We've researched them. We studied them. We've developed a guideline of factors that must be present for you to qualify as a trader in securities. Now, this is at a high probability you can qualify. Nothing is certain because, again, there is no code. There is no law about this. So, but from this body of tax court cases, we've come up with principles that we think that can qualify as a trader. Now, it's crucial that you work with someone that specializes in tax trading rules because if you do not, you're running yourself a risk. You can work with any accountant or CPA that you want, but if they don't specialize in this, as you can see, you have to have knowledge of these court cases and have the ability to analyze them. Then you're going to put yourself in a situation that's going to be increasing your chance of being audited, and if you are audited, you're most likely going to lose. And again, like I said, most accountants do not specialize in this because it doesn't make any point for them. Before I worked for Online Trading Academy in my prior firm, and also I had a business I owned in the past, there were maybe 1 or 2 traders in a year out of 1,000 clients. So you can understand it does not pay to specialize in tax trading. Now, let's get into what the IRS does say. And we have a publication 550. Now, a publication is not law. It is, if you will, a guideline in simple English to explain what the code means. But it is not binding because it's not law, meaning you cannot go with this to court and say, this is what the publication says. But let's look at the definition. You'll find this definition very vague if you read it carefully. It says that to qualify as a trader in securities, you have to, it's an individual that purchases and sells securities for his or own account with the expectation of making profit on daily market movements and not from dividends or capital appreciation. And the activity has to be substantial, continuous, and regular. If you read this definition very carefully, you'll see that it's not clear at all, because they do not define what daily activity means. So some people ask me, hey, Michael, do I have to trade every day? And the answer is absolutely not. Do you go to work every day? If you have a job, do you go every single day of the week to work, including weekends, including federal holidays? The answer is no, right? So daily is not defined here, but it could be theoretically every day, several times a day, every other day, 3 times a week. That's all daily activity. So it's not defined clearly what daily is. Then what is the activity has to be substantial. Substantial is a relative term. $5 may mean a lot to someone but mean nothing to somebody else. If your name is Warren Buffett or Bill Gates or one of the other billionaires of the world, probably even $50,000 means nothing to you. But if you're just an average working person and all you make a year is $50,000 is a lot of money for you. That's relative. Substantial is a relative term. But more so than this, what do they refer by the word activity? Are they talking about amount of trades you're putting in? Are they talking about the time you spend? Are they talking about the amount of money you're trading with? Which one is it? Is it a combination? Is there a certain threshold to this? What is it? So obviously, no, this is an excerpt directly from the IRS. So nothing there is clear. And then what's continuous? So continuous, we understand, is an activity without interruption. But what's defined as an interruption? They're not saying what's defined as an interruption. So I'd be out of the market for a day, 3 days, 3 months. What is considered as an interruption? And then last one, again, another relative term is regularity. So regularity is defined as something that you routinely do on a routine basis. So give an example. Some people work out 3 times a week. I work out once a month. That's my regular workout regimen. So it is different from person to person. But we have to go is understand what is regular. What did the courts decide is regular? What did the courts decide is substantial? What did the courts define as continuity? We won't find this in the publication. Now further on, they're showing other criteria. They're looking, for example, typical holding periods. How often do you hold these securities intraday, swing trading, position, months, years at a time. They're looking at the frequency, how often you're in the market. What is the dollar amount you're using? Meaning what's the the money you're using. It doesn't have to be dollars. It could be euros. It could be any other type of currency. But they're looking at the amount you're using per trade and for the year in entirety. So if you're buying, 5 shares of a stock that trades at $3, that's not going to cut it probably for you to qualify as a trader. But it doesn't mean that if you're trading for $20 million a year, you're going to qualify either. Because it's a myriad of elements that fall together. Then they're looking at the extent to which you're pursuing the activity to produce income for a livelihood, which means basically that you're trying to make money, that you have a plan of being profitable in this trading business, that you're not just doing this for fun. As I had this one guy once in a live event, I asked everyone, why are you guys here? Why are you trading? And they all said, and they were silent. So I said, are you here to make money or is this a game for you? And obviously most hands came up and said, no, we're here to make money, with the exception of one guy who said, no, this is a hobby for me. I said, that's an expensive hobby. So if that's a hobby for you, you don't need to worry about this. But if you're doing this to pursue income, to increase your cash flow, then you're in the right spot. So there's a few things we have to show that you're trying to pursue a livelihood, being one that you have a plan, a trading plan, and there's a logic behind it. Now, if you're losing money, that's not going to prevent you from qualifying as a trader. Obviously, making money helps, but that's not going to disqualify you from qualifying as a trader. And last one is the amount of time you devote to this activity. Now, notice that we don't have hard thresholds here, meaning you have to have 400 trades a year or 50 trades a year. You have to trade at least $50,000 in your account. We do not mention any of these elements here because it is different from person to person. And I'll share with you at least maybe one story, one court case actually. There was a gentleman who traded 1,000 trades for the year, which is fairly substantial, averaging 4, 5, 6 times trades a day, sometimes more than that, depending on what he was trading. Very profitable. Got selected by the IRS. IRS said what he is, an investor. Why? Well, that's a default. So they're always going to claim that. What did he claim? He's a trader. What happened? They went to court. The court reviewed his case and determined that this gentleman is an investor indeed. So there's a question here. That gentleman traded 1,000 trades, substantial. He traded over, I think, $10 million for the year, meaning the turnaround of money was over $10 million. Because if you have a stock and you buy 50,000 and sell 50,000, you do this for 20 times, that's $1 million. So obviously, if you did 1,000 trades, it's not difficult to get to $10 million. So he had $10 million worth of trades, 1,000 trades, and he was profitable. But what happened? The court said he's not a trader. So on the surface, we would think he's a trader. But what happened is that his continuity was not established the court said he did not establish continuity. What happened with that person, that he was out of the market, he only traded for 3 months of the year. He was very, very active in 3 months. But then he decided to take a long vacation. I think he went on some yacht cruise thing for 6 or 7 months. And he did not trade at all. The court said, you did not establish regularity, and you did not establish continuity. So you can see that if we say that you have to have a certain amount of trades, some people out there will think that's all that needs to happen to qualify. Therefore, we do not have any type of threshold. When you work with us personally one-on-one, we talk with you about your needs, about what are you trading, the type of assets you're trading, what kind of money you're working with, what are your average holding positions. We look at all of that together and we say, you know what, you qualify or you don't qualify, or you don't qualify, but here's how you can qualify. If you tweak this and that in your trading plan, then you will qualify. And that can only be done on a one-on-one consultation. And we offer these consultations via the phone. If you're not, we're located in California, Irvine, California, the headquarters of Online Trading Academy. So obviously, if you're not here physically, we can do this over the phone. Now, what are the advantages of being a trader in securities? So let's go through them quickly. The first one is you have the ability to elect what we call mark-to-market accounting. So with mark-to-market accounting, remember I asked you that question at the beginning of the webinar. Mark-to-market accounting is an accounting method that you mark your open positions to market prices. Suppose you're at the end of the year and you've got a stock that you bought for $100. It doesn't have to be a stock. It can be an option. It doesn't matter what it is. Let's just use stocks, for example, because it's simple to understand. You bought a stock for $100, and now it's trading at 85. Normally, you can't do anything with that unrealized loss. If you want to take that loss, you have to sell your position. And then you have to be out of that position for 30 days. So when I say out of that position, that means you cannot own that stock through any other account, including your retirement account. You cannot buy an option or write an option on that specific stock. So anything that is the asset or the underlying asset, you cannot be in within 30 days if you want to claim the loss. So that's a problem. So what do? If we elect mark-to-market accounting method, which is a method that is reserved only for the trader, we'll be able to write off this loss without selling this position. How is that? Because what we do is we take that stock and we market the market price. That's why it's called mark-to-market accounting method. We look at the last trading day and see the closing price of that specific position. So if that specific position was $85, we'll mark it at 85. So we'll show as if we sold that stock for 85, basically claiming that $15 loss without selling it. So it does not affect our style of trading. So if tomorrow the stock starts to gap up or run up because that's what we expected it to do, we're not out of the hunt. We're not out of the upside of the transaction. Yet we still claimed the loss when we had it. So that's an immense benefit to have. And it's only reserved for the trader. Only traders can elect this mark-to-market accounting method. And basically what mark-to-market accounting does, it converts everything from capital gain loss treatment to ordinary gain loss treatment. And when it does that, it eliminates the washdale rules and that $3,000 loss limitation we mentioned earlier. These are great advantages to have. But more than that, it allows you to write all of your expenses. The trader security status allows you to write all of your all of your ordinary business expenses. Everything. So we're talking about the equipment that was not deductible for the investor, and people spend $3,000-$4,000 a year on computer, on hardware, on hard drives. You want to have a strong computer when you're trading. We're talking about home office expenses. For the average person, we're talking about at least a few $1,000s a year you can write off there. Then we're talking about the margin interest, the internet, the trading expenses, the research, seminars, travel to conventions. So if there's a trade expo somewhere in Europe and you'd like to go there and you can justify that it is needed for your trading business, then you'd be able to write that off. The cost of going there, meaning the flight, your hotel, your rental car, your meals, pretty much everything. So you can combine, by the way, business with pleasure, provided that you spend enough time in business-related activities. You'll be able to write this off. I mean, we're talking about if you're going to Europe for 5 days, we're talking about a couple $3,000 for that trip. You figure $700-800 for airline ticket. You figure another $150 a night for hotel. So there you go, got about $1,500 right there. You take a rental car, or you take taxis, a few $100s there, and the meals. You're easily at $2,500. That's before even paying for the convention itself. And that'll be all deductible for you if you're a trader. You got to qualify as a trader. So what we say is, give us a call. See if you qualify as a trader. You won't be able to find out this on your own. Or if you call your current account, they probably don't have any good advice for you. So you look at all of these benefits that you have. Now, I want to stress out why it's important, again, to work with someone that understands tax rate rules. I see this all the time. I give you two short stories. First, one guy came a few months ago. Some company set him up with a corporation. That was not bad advice by itself. The issue was that this gentleman was working at the time 70 hours a week. He was heavily worked where he was working. So he didn't really trade. And he did not like the customer service of the company that set up the company, so he went to his current CPA, which he was working with 15 years. He just sat here the other day working with me on his 2011 taxes, and he said, I haven't even notified my accountant yet. So, and basically what happened is, he went to his accountant for 15 years for his 2010 return. And she filed him as a trader. The issue was that he only posted 9 trades for the year. That's it. 9 trades for the year. So without being an expert on this, you can understand that if you average a trade per month and a half, you're not going to qualify as a trader. Yet she qualified him as a trader in her eyes. So what will happen is this gentleman is exposed to an IRS examination, which in his case would cost him about $5,000 a year. Not a lot of money, but for 3 years we're talking about $15,000. And then we got to add to that penalties, interest, and so on and so forth. We're talking about $22,000 or so. Then yesterday I had another girl that she worked with an accountant, and her accountant reported her futures trading on the wrong firm altogether. And then her accountant wrote off her education as a tax credit, which she couldn't do. So there was on and on problems with her return. And she's also exposed to an IRS audit. In her case, it's only a few $1,000s. But again, it's never fun to open up a year when it's 2013 and you got to open up your 2010 return, and you're not going to remember what happened 3 years ago. And maybe some of your records are not there. That's going to be challenging for you. So now that we've established a few things, I want to kind of sum up this section. Being an investor poses a lot of disadvantages. I want to show you quickly the disadvantages again. These are all the disadvantages the investor has. The limitation on losses, the wash sale rules, disallowance of expenses, margin interest limitation, so on and so forth. Reminding you that to be a trader, there is no code, just court cases, so you need someone who understands how to navigate through these court cases. We showed you the definition. And then we showed you all the benefits of being a trader. Okay? Writing all of the expenses. So you understand that what you need is, you need to find out where you stand. You're a trader or not. So here's what we offer you today. And after I give you the offer today, you can type in some of your questions, and we'll try to answer some of your questions today. So what we're offering is very simple. To set up a consultation with us, we'll analyze your situation in depth. We'll review your taxes, your last 2 years of filing. We have a promotional for you. Usually we charge $250, but because of the FX Street special today, we're going to charge you only $150 for that, which you will be able to apply towards any type of future services that we do. That may be tax preparation, that may be setting up a company for you to trade, and so on and so forth. And we'll develop a strategy specifically towards you, your needs, what you trade, what you need, that will maximize your tax savings. Will save you thousands of dollars, increase your cash flow. So I think it's something that anyone who is trading needs to look at it seriously. And we're looking at about $150 as a cost. It's nothing. It's like a few transactions of commissions. It's not even a substantial expense to you. And again, take the advantage of today's offer. It's only for people who are attending today's webinar. Like I said, normally it's at $250. So the way to reach us is very simple. You can call us. We have a toll-free number. It's right there on the screen. If you can't see it, I'll read it. It's 855-682-7767. An easier way to remember it is also 855-OTA-PROS. You can also email us at info@otataxpros.com. At this point, feel free to ask any type of questions. I'll try to answer them. I already see I have a few questions. Rich from Jersey Shore is asking, will you have your PowerPoint presentation available to us later? I don't think we'll have that available later. Then Boyke is asking, which period is USA tax year from to? So tax years run usually for most people as a calendar year from January 1st to December 31st. And yeah, they're recording the webinar so you'll be able to listen to it again. That's what I'm seeing we're doing. We don't have the slides, but we're going to be recording, and it's going to be in the archive. So Fernando is asking, is there any form of tax withholding of profits regarding non-U.S. residents opening accounts and U.S. brokers? Well, normally for non-U.S. residents, it depends on the country you have, what type of agreement the country has, but normally there shouldn't be any withholding of taxes if you're considered a foreign resident. If you have dual residency, meaning you're an American citizen or you have a permanent resident card, or you're just staying in the United States but you're not a U.S. person, then there will be withholding. It depends on your legal status, basically. Then I have another question here. Futures trader more favorable than stock trader? Rembrandt is asking. That's right. I've actually written an article in the Lessons from the Pros. I don't know if you get that. It's a newsletter that Online Trading Academy distributes to about close to 100,000 people every week. And there I talked about the benefits of actually being a futures trader. First benefit is you get what we call the 60-40 split, meaning each transaction will be taxed as follows. 60% of it is going to be long-term capital gain rate, and 40% is going to be short-term capital gain rate. So what we're talking about is one huge advantage, because remember, for the active trader, everything is going to be ordinary short-term capital gain rate, which is ordinary income. So that's a huge benefit future traders have. Also, future traders have mark-to-market treatment embedded in the trade, so there's no wash sales. The tax reporting is much easier than those who are trading stocks. And the last or huge benefit to have as a futures trader is the fact that if you have losses in a given year from futures trading, you can take those losses and offset against gains you had prior years from futures trading. Only from futures trading. So it's a benefit only reserved for future traders, or unless you have filed what we call the mark-to-market election, and then you can take those losses in full or backwards if you don't have enough income. So I hope that answers your question. Alon is asking, I live in Canada now, how is this applicable to me? So we don't treat with Canadian taxes at this point. We might roll that out later. So I'm sorry not being able to answer your question right now. Boyke is asking, what does CPA stand for? That's a Certified Public Accountant. Then Rich from Jersey Shore is asking, can I consult with you but still file my taxes with my current accountant with your recommendation? Obviously, you can file your taxes whenever you want, but we'll prefer that you will do your taxes with us because we don't want to take any type of responsibility for giving recommendations to you, and then you take those recommendations given to your accountant, and so on and so forth. What we can do, what a lot of traders do with us, is they let us file their returns regarding with the trading activity or their business if they have one. And if they have other businesses and they want to stay with their current accountant, we do not prevent them from doing so. And then Rich is asking, so a Forex trader cannot take advantage of a 60-40 split. It's not necessarily true. It depends how you trade it. It's kind of complex to explain right now. But Forex traders can have an ability to elect a 60-40 split. They can treat it as futures contracts, depending on how they trade Forex. Okay, there's different ways to trade it, obviously. What you can do is you can elect out of Section 988 and then make the election to be treated as a 60-40. So it's a complex process, but it's doable to get the 60-40 split. So again, first of all, I want to thank you all for the questions you've had. Those are all great questions. And again, what we recommend is for you to give us a call, because obviously what we did today was for educational purposes. There's a lot of general information. None of it is specifically tailored to your situation. It's simply impossible to do this over a webinar because we have to learn what you do. That's why we have this consultation in 1 hour. We ask you different questions. What is your job? What do you trade? So on and so forth. We come up with all the information. And then based on that, we can decide if you qualify, yes or no. And what is another strategy you may have if you don't qualify. So it's super important for you to find this out because you don't want two things to happen. A, you don't want to pay more money to the IRS than you're already paying. And number two, you definitely don't want to get examined by the IRS. And just, again, to let you know, last year the IRS increased its examinations tremendously. And this year they're going to do more of the same because they figure out a way. It's actually, it's funny, but it's true, that you can raise taxes without raising taxes. How is that? If you increase the rate of audit, and if you have more of a hard line, you're going to get money from the citizens, because most citizens or most U.S. persons will say, you know what, I'd rather pay an extra $4,000 or $5,000 and finish this than drag it over a 2 or 3 year period. And on average, you're able to collect about $8,000 from the taxpayer. So you can understand, there's some people paying $2,000, there's also some people paying $50,000. So obviously, that's an easy way to raise taxes without raising taxes. A lot of governments do this at first until they realize it upsets the citizens, and they actually raise the tax rate. So that's, I think, surely to happen in the next few years. That's just my estimation. I don't have any perceived knowledge ahead of that. So again, thank you so much. We appreciate you taking you taking the time today and being with us. We hope you enjoyed it. Thank you so much. I always like to hear some feedback, so I appreciate everyone's remarks. Thank you, Rembrandt. Thank you, Fernando. Thank you, Carlos. And we'll hope to hear from you shortly. Have a great rest of the day, and have a success in trading. Thank you so much.